So let's start with our next topic, that is inherent limitations of audit. So, like we discussed before, an auditor only gives a reasonable assurance that the financial statements are free from material misstatements. That is because of the inherent limitations of the audit. So, the inherent limitations are certain inbuilt limitation due to which an auditor cannot obtain an absolute assurance. These fundamental limitations arise due to the following factors. So let's discuss these factors that affects the auditor's judgment. So first one is nature of financial reporting. Preparation of financial statements involves making many judgments by management. These judgments may involve subjective decisions or a degree of uncertainty. Therefore, auditor may not be able to obtain absolute assurance that financial statements are free from material misstatements due to fraud or error. That's because the assumptions or the judgments made by the management may be wrong. But when auditor checks with the relevant audit evidence, the auditor might be of a view that the financial statements show a true and fair view. So, this is an exam question, okay? The premise. The premise for conducting an audit is that management acknowledges its responsibility of preparation of financial statements. So, we had discussed before that the responsibility of preparation of financial statements is of the management, and the auditor just have to review or audit the financial statements. So, premise for conducting audit is that management acknowledges the responsibility of preparation of financial statements in accordance with applicable FRF and for devising suitable internal controls. However, such controls may not have operated to produce reliable financial information due to their own limitations. So that's nature of financial reporting. Next one is nature of audit procedures. So the auditor carries out his work by obtaining audit evidence through performance of audit procedures. However, there are practical and legal limitations on ability of auditor to obtain audit evidence. Like we discussed that audit is not an investigation. The auditor does not have search rights or something like that. So the auditor just gets whatever the management provides. See, for example, an auditor does not test all transactional balances. He forms his opinion only by testing samples. That's a practical limitation. And like I said, management may not provide complete information as requested by auditor. And there's no way by which auditor can force management to provide complete information. That's a legal limitation. And then the management may consist of dishonest and unscrupulous people and may be itself involved in fraud. It may be engaged in concealing fraud by designing sophisticated and carefully organized schemes which may be hard to detect by the auditor. It may produce fabricated documents before auditor to lead him to believe that audit evidence is valid. However, in reality, such documents could be fake or non-genuine. So, since auditor is not an expert in detecting a false document, this falls as a liability in his opinion, in his forming of his opinion. See, like I said, auditor is not an expert in authentication of documents. It is quite possible that entity may have entered in some transaction with related parties. Such transaction may be only paper transactions and may not have actually occurred. The auditor may not be aware of such related party relationship or audit procedures may not be able to detect probable wrongdoings in such transactions. So, nature of audit procedure is the second limitation. Now, the third limitation is not in nature of investigation. So, as already discussed, audit is not an official investigation. Hence, auditor cannot obtain absolute assurance that financial statements are free from material misstatements due to fraud or errors. Now, the fourth limitation is timeliness of financial reporting and decrease in relevance of information over time. The relevance of information decreases over time, and auditor cannot verify each and every matter. Therefore, a balance has to be struck between reliability of information and cost of obtaining it. Let's see this example. Consider, for example, an auditor who is conducting audit of a company since last 2 years. During these 2 years, he has sought detailed information from management of company regarding various matters. During his third year stint, he chooses to rely upon some information obtained as part of audit procedures of second year. However, it could be possible that something new has happened and that information is not relevant. So, information being relied upon by auditor is not timely and may have lost its reliability. So, whenever we do an audit, we should check the timeline of whether the audit evidence is still relevant for us or not. Now, the last limitation is future events. Future events or conditions may affect an entity adversely. That is going concern. I hope you all know what that means. So, where do we have going concern other than this? That's Caro that we will be learning later. So, future events or conditions may affect an entity adversely. Adverse events may seriously affect the ability of an entity to continue its business. That is its going concern. Its going concern might be affected. The business may cease to exist in future due to change in market conditions, emergence of new business models or products, or due to onset of some adverse events. Therefore, it is in view of above factors that an auditor cannot provide a guarantee that financial statements are free from material misstatement due to fraud or error. So basically, if going concern is not reported properly, the financial statements may not show a true and fair view, because the FS, as we know, is prepared on going concern basis. That next year the entity will be there, it will be in operations. So what the problem is, if going concern is not there and we report that going concern is there, it will result in showing that the FS is inappropriate. So going concern is one, it's there in Caro, and another, it's there in audit report. So let's summarize what we learned. It is 1 second. Okay. So let's summarize what we learned. So this was inherent limitations of audit, where we discussed five inherent limitations. One, two, three, four, five. Okay. So the first inherent limitation was nature of, I'll write it again. It was nature of financial reporting. Next one is nature of audit procedures. What was the third one? Third one was not an investigation Investigation. Fourth one was timeliness. Let's write the full thing. It is timeliness of FR and decrease in relevance. Timeliness of financial reporting and decrease in relevance over time. Last one is and future events. So that sums up inherent limitations of audit. So inherent limitations of audit are as per SA 200. Inherent limitations of audit as per SA 200. The auditor is not expected to and cannot reduce audit risk to zero because there are inherent limitations of an audit. The inherent limitations of an audit arise from the nature of financial reporting, the nature of audit procedure, not in the nature of investigation. So that's inherent limitations of audit. Thank you.